Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking commodities as we continue to see a run higher in almost all the commodities. Gold closing in at 2,400, silver right below $30, that key $30 level, and copper again making another run higher when it had just touched new all-time highs, and right now in the futures market just below $5. We're chatting right now with Jesse Felder, founder and editor of the Felder Report. Jesse, it seems like we continue to see money flow into the commodities sector. It seems like a lot of sectors, in all fairness, are doing pretty well as markets are also at all-time highs. But this move into commodities, it's precious metals, it's base metals, it's energy, it's all of it. What do you think is leading to a bit more focus within, I guess, the financial industry towards the commodities sector?
Well, let's be clear. I mean, the prices are moving higher, but there are no signs of investor demand yet really moving for these things. If you look at fund flows and things, all the money that flowed into commodities a couple of years ago has flowed back out. And there's been no turnaround in that. You look at that in the precious metals ETF. So investor demand still isn't even anywhere near where it would be to really kind of validate a powerful bull market move. Now, I take that as being very bullish. But yeah, the commodities prices themselves are ripping higher. I mean, with the exception of oil right now. I mean, you have, nat gas prices have started to lift their head off the floor and are looking well. But yeah, the copper price, especially, testing all-time highs is very interesting because that's typically a pretty good lead on inflation going ahead over the next few months. And so, it suggests that markets celebrating an in line with expectations inflation print today is maybe not a justified cause for celebration.
Well, and Jesse, you just wrote a great article a couple of weeks back, summarizing and compiling a lot of data, and it was the bull case for commodities is as strong as ever. And people can see that over at the Felder Report. But you made in there that the commodities are moving higher because of four reasons: reaccelerating U.S. growth, which I think surprised a lot of people; geopolitical uncertainty, which we've had in spades; segmentation of global trade; and strong AI demand for energy. We just spent a couple minutes before the call just talking about that last point. Just not just AI's demand for energy, but crypto mining's demand for energy, and the continued EV conversion. If you're going from internal combustion engines to plugging in and charging at home or charging stations, all this power demand is going to result in more commodities needed, not just for the energy generation, but also things like copper for the energy transmission. So maybe let's camp out there for a second and just talk about the huge energy demands that we're seeing in culture right now.
Yeah, I mean, we're seeing essentially inflation in electricity costs, like we haven't seen in a long time, really since the 1970s. We saw a big boom in kind of electricity inflation prices in electricity during the last commodities bull run from 2000 to 2000, whatever, 8, 9 time frame. But this time we're seeing electricity prices rise even faster, and really not a faster rate than any time since the 70s into the early 80s. And I think that's simply just a function of demand, right? We've not had a lot of investment in this segment of the economy, and right now demand is growing at the fastest rate we've seen in a long time, right? So you mentioned it, EVs, which are putting, as you see greater adoption in electric vehicles, you're going to see greater demand on power. But I think the big one right now is that people are talking about are data centers, growth in data centers to support the boom in AI. And as we were talking about a minute ago, Goldman Sachs points out that currently data centers have a demand of about 15 gigawatts, and that's equal to all of the solar farms that were deployed across the country last year. That's expected to triple from 15 to 45 gigawatts. So, but all sectors of power demand are growing, and so you hear a lot on CNBC, whatever, people talking about utilities are the new AI play. Well, I think that's, backwards, right? It's not the, power companies, who are highly regulated and profits are highly regulated are the play here. It's where does the power, come from? How are we going to generate the power? And I really think natural gas is probably, to me, the most logical source for generating a lot of power very quickly. And natural gas prices are so depressed right now that I think there's a real opportunity there.
So Jesse, where does the investment angle come in for investors looking at individual stocks or ETFs to invest in? If they agree with this whole outlook that we need more energy, we're going to be creating more energy, but that takes some money and investment should follow. Where do you look for that?
Well, the natural gas producers, have really kind of started to discount a little bit better pricing and things. There's stocks like, that I've been following for a while. Devon Energy is one, Comstock Resources is another, where these stocks trade at very reasonable valuations. Compared to the broad stock market, they are historically very cheap. And that's just because, like I said, investors really don't have a lot of interest in these areas. They're much more interested in, the semiconductor things and Magnificent Seven stocks that have driven the market for years up until this point. But I really do think these natural gas producers are in a position to where if demand is going to, energy demand is going to continue to grow as houses like Goldman seem to project, then it's going to put a great demand on natural gas, because I think that's going to be of all the potential sources of energy, obviously far cleaner than coal, and there's plenty of natural gas in the country to power natural gas fired plants. And so I think it's readily available and it's relatively clean. It's probably in the best position to meet those needs in the shortest amount of time.
Yeah, Jesse, we've had a couple other guests on the show that were mentioning that nat gas power plants are going to be in vogue just to help power all these. We've also seen a couple of these data centers actually buy nuclear reactors or try, make bids to buy them. And there's also a big movement to build small modular reactors where there were coal-fired plants. And there's a couple of, even Bill Gates is getting on that train and trying to build some nuclear reactors to fund the data centers. So we're seeing that. But everybody forgets that, hey, if you generate the power, how are you going to get it there? And you still need copper wiring to plug into EV stations, to plug into data centers. So copper is continuing to break out, as Corey mentioned at the onset. Just made an all-time high earlier today, intraday. Copper stocks, though, have just kept rocking the producers, not so much the juniors. How are you looking at copper and then the copper equities?
Well, the equities are something that's, they're interesting, right? Freeport, FCX is the one, kind of the major one, and it's had a really nice run over the last 9 months or so, and it probably has, discounted a good portion of this run in copper. To me, the primary trend in copper is very bullish, right? It's clearly, it's a chart that it couldn't be more obvious, is, up and to the right, and momentum is very strong. And the breakout from the pennant pattern that it formed over the past couple of years is also very bullish continuation. So I think copper prices are very clearly telling you that they're headed higher. I think of a Paul Tudor Jones quote. He said, when prices break out to a new range, it's a very clear signal that they're going to continue in that range for a period of time. And I think, I'm just reminded of that quote when I look at copper, because it's like a textbook example of that type of technical analysis. In the short run, it may have, have some consolidating to do. But longer term, the supply demand dynamics are very bullish. As you point out, the demand for copper is only going to get stronger. And there's really, a geopolitical issue here now too, with the separating of supply chains and things. Copper is being looked at by both the U.S. and China as a strategic resource, and so I think that this is going to be a story that's going to play out over a number of years. Copper prices are going to continue to rip higher, but as I point out, I think for me, from an investment standpoint, I'm most interested about the inflation implications, the inflation story that copper is telling right now, because I think still the markets are focused on this idea that inflation is going to come back to the Fed's target. They're going to allow them to cut interest rates, et cetera, et cetera. The copper price is telling you no, that's not going to happen. That inflation is in the process of actually bottoming and turning higher. And if that's the case, then the Fed's going to have a real problem on its hands.
From the investment side of things, investor demand for copper stocks, why do you think we've seen so much more investment demand for copper stocks compared to something like gold, where gold even broke to all-time highs and is held there? The copper or the gold stocks, they aren't anywhere near all-time highs, the majors, but the copper stocks, those are at all-time highs, as you said, almost front-running this copper price.
Yeah, I think that the gold miners are still, I'm talking about the major miners are look like, they're breaking out today. Look at the GDX, and it's breaking out to a new, this would be a closing high today, 52-week high for this thing. So to me, that's the same message as the copper price. That technical message of when something breaks out of a range. It's sending you a clear signal that it's headed, further in that direction. I think that's what's going on with the gold mining stocks, and they're still really cheap, which is basically just a function of the lack of investor demand. Now, what is going to change that investor demand and really see the value in these stocks kind of represented in the market? Well, this is something that we've been talking about together for many months now. Luckily, it's been nice to see they've had a good run over the last few months. Many of these gold mining stocks. I do think that's just the beginning of more to come as the investment thesis shifts or investor preferences shift. Right now, investors are still playing in the markets using a soft landing playbook. And that soft landing playbook means inflation comes back down to target and the economy is going to stay relatively solid. I think there are too many signs right now suggesting unemployment is trending higher. That solid side of the soft landing narrative, solid economy, is really going to come under strain, I think, if we see unemployment continuing to head higher, which a lot of signs point in that direction. At the same time, inflation remaining sticky. So if a soft landing narrative begins, and I think this is what drove the correction that we saw in stock prices last month, is people started to question the soft landing narrative, and you started to see a stagflation narrative creep in. Now that's been unwound over the last couple of weeks, but if that starts to come back and you start to hear investors worry a little bit more about stagflation again, that's where you'll see a rotation out of things like semiconductor stocks and the Magnificent Seven and into things that would benefit in that type of environment. And gold miners are one of the first things that should come to mind.
Well, and Jesse, you just penned an article recently, and it was titled "The Search for Stability," and you were making some points that kind of tie into this conversation about how investors in a world that it seems rather uncertain, both geopolitically and just even in the financial markets, there is a quest for more stability in one's portfolio. So when you look at housing, when you look at things like the bond market and what's happened, some of those things haven't worked the way people thought, but they are turning to gold. Isn't the reason that a lot of people aren't getting into the gold markets or into gold itself a little different than maybe some of the other commodities?
Yeah, where people are looking for stability, is in China, right? It's the Chinese buyers that are buying gold hand over fist, and it's central banks. So these central banks that are buying gold are looking to, de-dollarize. They're reducing exposure to treasuries and dollars in general, and they're using gold as ballast. And so I think that's something that investors will eventually, Western investors will eventually come around to that idea. But right now, the performance of gold, or the demand for gold in the West, is kind of inversely correlated to confidence in the central bank, right? When people are super confident in the Fed and they believe in a soft landing narrative, I have no need to own any gold, right? If that confidence begins to wane and people begin to think that the central bank is not going to execute on its mandate on either side, on the employment side or on the stable prices side, then people lose confidence in the mandate and the demand for gold will rise. That's kind of what we're seeing in China, as people are losing faith in the currency and in assets financial assets priced in the currency. And I think that's kind of a prelude of what to expect here at some point over the next 6 to 12 months.
So if we're looking at commodities, right, it's all very positive right now in terms of the moves we're seeing in a wide range of commodities. What stage of a bull market are we in right now in your eyes, Jesse?
Well, I think we're still in the very early innings. Bull markets begin on pessimism and end in euphoria. We are still in the pessimism stage, right? Investors don't have any, they don't believe in the commodity story. There's no money that's flowing into precious metals or into energy stocks or into commodities funds generally. So we're literally still in the pessimism stage. So that would suggest we're very early on in the bull market. And so it's a long time before we're going to see, and a lot of price runway ahead before you start to see the type of euphoria that would be kind of indicative of a major price top. So we're still very in the very early stages here.
Well, Jesse, speaking of early stages, we haven't talked about silver yet. Silver is doing well. It's been rallying and it's getting close to that $30 resistance level, but it's nowhere close to its all-time highs like gold. It's nowhere close to breaking out and ripping higher like copper has been. But since it's a hybrid metal, part precious, part industrial, with gold and copper doing so well, do you expect silver to finally kick on its afterburner soon?
Oh man, I mean, silver is actually breaking out to a new, 52-week high today. It would be a closing high, which again, very, very bullish. But if you look at, just the technicals of it, really from mid 2021 to mid 23, we formed this huge head and shoulders bottom pattern. We broke out above the neckline of that pattern and just came back to test it around $25, $26 over the last couple of weeks. That test held, and now we're reversing higher and making new highs. So this, head and shoulders bottom pattern projects a target that's, significantly higher. I mean, let's just measure the head is around 18 to about 26. So that's, $8 of price above 26. You're talking about $34 target, over the next probably several months. So I think that, yes, silver has been the laggard, but now I think it's poised to lead. And that's exactly what you would expect in a bull market is, some of these higher beta things to start to really take off. And silver looks to me like it's just, on the verge of breaking out to new highs above that 2020 high.
Jesse, what do you take away from the fact that we're seeing kind of this bull market action in all kinds of commodities, but then we're also seeing the U.S. equity markets touching all-time highs today too? It just seems like a good environment for investors in a wide range of areas.
Yeah, it's where we are at this point in the cycle, right? We've had, just look at the monetary cycle, right? We've had interest rates rising for the past couple of years, and we haven't obviously fallen into recession. And so there's been worries about, the economy and things, and now those worries are kind of falling to the wayside, and this soft landing narrative, which always comes up at this point in the cycle, right? You get a rise in interest rates and the economy doesn't immediately fall into recession. And people say, wow, okay, phew, let's, now we can be bullish again. And they usually do that right at the wrong time. And I think this is just another case of that type of a setup where, everything is rallying in relief that, the rise in interest rates didn't kill the economy, but it's a little bit too soon for that to happen. I really do believe that rather than a soft landing, we are headed for stagflation. And if that narrative begins to overcome the soft landing narrative over the next several months, you're going to see a shift where certain assets are going to perform a lot better than others. And I think that, the breakout in precious metals, for example, is real. And to me, that's, very clear sign of much more to come in that space. Now, stocks, right, you have so much breadth divergences here and things that we've been talking about for months now. S&P, NASDAQ breaking out to new highs. Russell 2000 still nowhere near, confirming and a lot of stuff going on under the surface with weakness in terms of the stock market. So I think this quote unquote breakout in S&P and Nasdaq is going to likely to prove to be a fake out as the celebrating the death of inflation is a little bit too early, and also celebrating the soft landing in the economy, right? The economy is probably headed for a further rise in unemployment in the months to come, and so it's going to put the rising unemployment and sticky inflation really makes it difficult for the Fed to do anything that would be supportive of asset prices at all.
Well, Jesse, speaking of celebrating and getting overexcited, do you think the market at the end of last year, when there was the famous Powell pivot party, because there was going to be 7 rate cuts this year, got a little overly excited and kept partying into this year? But then as those rate cuts have been pulled off the table and they've been perpetually moved back, where some people expecting 1 or no rate cuts this year, the market doesn't seem to have cared. They just kept rallying. Did the market, in a sense, switch narratives to something different than waiting for the Fed to come in and put easy money in? Is there something else fueling these markets higher besides the Fed expectations?
I mean, it's leverage, it's euphoria, it's speculation, it's all of those things, right? I think there, and to be fair, earnings have been fairly strong. I think what markets are discounting now is though a significant return to significant earnings growth over the next couple of years, and I think that's where they're probably headed for disappointment. But right now, you can see it in GameStop, AMC, right? There's still a great deal of animal spirits in the markets right now, and I think this comes back to that Fed pivot late last year, where Jay Powell said we're probably done. We're not only done raising interest rates, we need to start looking at when it's appropriate time to cut them. That gave the green light to speculators and to animal spirits to go ahead and go nuts. And that's exactly what's happened. And I think that's more than anything else, that's what's driving stock prices right now, is really a speculative euphoria. And it's not a healthy market when you see things like GameStop screaming higher 400-500% on no news, and it taking along stocks like AMC and BlackBerry and whatnot, speculative kind of meme stock favorites. You see this in a broad swath of things. I mean, you could even look at Apple, right? Apple's trading 30 times earnings at a time when sales growth is declining and earnings are under pressure. This is a stock that's traded 12 to 15 times, even when the iPhone was growing, because it was they hadn't even gone into the China market yet. So even when sales growth was massive at Apple, it traded at a much smaller multiple than it does today. And that 30 multiple on a stock like Apple is I think, to me, just a sign of over exuberance in markets, because especially if we get a recession, that's going to further hurt things like iPhone sales and Mac sales and all that kind of stuff. And so I think you can see it in almost any area of the broad stock market. There is a speculative fervor, animal spirits, for lack of a better term, that's really been driven by a Fed who gave them the green light 9 months ago.
Yeah, what an interesting market. Hey, a lot of all-time highs, a lot of breakouts that we continue to see. I guess still waiting for a bit more weakness in the economy, waiting for the Fed. We're waiting for a lot, but investors, well, they seem to be spreading their bets out as well. We have seen more money come into the commodities, which were lagging. They're playing catch up now, but that's also in the face of some of the big caps as well, doing decently. So lots of opportunities for investors, but you've outlined some scenarios here where that could very much change and even go more in the favor of commodities. Jesse will post a link to the Felder Report so everyone can stay up to date with you. We'll chat again next month. Thanks for your time. I hope you have a great rest of your week.
Thanks, guys. Take it easy.